The 4% rule. For decades, it's been the cornerstone of retirement planning. It promised safety, predictability, and freedom. But what if I told you that, based on current Morningstar data, the success rate of the traditional 4% rule for a 30-year retirement has dropped to barely 70% in high inflation environments? Think about that. 3 out of 10 people relying on that rule might run out of money. That's a 30% failure rate for a strategy built to last. And almost no one I worked with believed me at first. It's tough to challenge something that feels like gospel, something that financial magazines have been printing for 20 years. I get it. It creates confusion and anxiety. You've done the math, you hit the number, and now I'm saying the number is wrong. But by the time we're done, this number will look completely different, and you'll know exactly why your retirement plan needs to be dynamic, not static. Welcome back. I'm Clara, and this is Wealth Logic, where we make retirement make sense. In this discussion, you'll get exactly why the original 4% rule, based on the Trinity Study framework, doesn't fit the realities of modern retirement life. I spent 2 decades helping pre-retirees navigate these exact decisions. This framework works for those willing to adapt. Before we get into it, everything here is educational, not personalized advice. Your situation is unique, so take this as a framework and review it with a qualified professional. Let's start with why this rule became so popular in the first place. It sounds so simple, and simplicity is powerful. The common belief, based primarily on the 1998 Trinity Study, is straightforward. If you take 4% of your portfolio in the first year, and then adjust that dollar amount for inflation every year after, your money will last for at least 30 years. The 4% rule gave people a concrete finish line. You could calculate your magic number and feel done. But here's the doubt. Was that study, which used historical market data up to 1995, actually built for the market conditions we face today? When I look at retirement plans that fail, it's rarely due to huge, unexpected expenses. It's the slow, steady erosion caused by relying on a static rule in a dynamic economy. We need a reality check. The core flaw of the 4% rule is its reliance on fixed, backward-looking market assumptions. It assumes smooth sailing and predictable returns that simply don't exist anymore. Named sources like Morningstar have researched this extensively. Their recent studies suggest that a more current, sustainable withdrawal rate for a modern 30-year retirement might be closer to 3.3% or even 3.0%, especially if you're retiring into an environment of higher inflation or lower bond yields. Let's unpack 3 major risks today's retirees face that the original 4% rule didn't adequately account for. The first is longevity risk. The original 30-year window assumed retirement from age 65 to 95. But according to SSA.gov, a 65-year-old couple today has a significant chance of one spouse living past age 95. You might be planning for 35 or even 40 years, not just 30. Does your withdrawal rate account for that extra decade? Next is the inflation problem. The annual inflation adjustments in the 4% rule are brutal during periods of sustained high cost of living. BLS data shows that inflation can quickly erode purchasing power, especially for non-discretionary costs like healthcare. If you start with $40,000 and inflation runs at 5% instead of 3%, that withdrawal amount balloons, draining your principal faster than your investments can recover. And finally, sequence of return risk. This is the killer. If the market drops early in retirement, say in your first 2 years, and you are forced to sell shares to maintain that 4% withdrawal, those early losses are catastrophic. You lock in the loss, reducing the number of shares that can benefit from the eventual market rebound. It's what I call the Trinity flaw, a fixed plan in the face of market chaos. Let me tell you about Margaret. This is where I saw this pattern play out hundreds of times. Margaret was a 63-year-old retired municipal planner from San Diego. She had $1.2 million saved, and, following the 4% rule, she thought she could take out $48,000 in her first year. Her fear wasn't running out of money. Her fear was having to constantly worry about it. She retired right before a minor market correction. When we adjusted her plan to be dynamic, meaning she agreed to take a slightly lower withdrawal, closer to 3.5% in the years the market was down, that one change gave her back her peace of mind. This brings us to the behavioral logic. Why do people get the 4% rule wrong? Because we, as humans, focus on the average. We look at the 10% average annual return and assume that's what we get every year. We ignore the sequence risk because it's hard to visualize a bad first 10 years. It feels correct, mathematically, but it ignores the reality of market distribution.